Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good day. Ira Epstein of Linn Associates with your agriculture update, and this is for Tuesday, the 20th of March, 2018, and we're at 1:50 p.m. Central Daylight Time. So we have a dollar that's, again, very strong. We have most currencies down against it. We have the FOMC meeting tomorrow. We'll find out exactly what that's going to do. We get a statement today out of the G20 with all kinds of concerns about a trade war. We saw Germany's EW index, drop as consumer confidence there is getting shaken about a possible U.S., let's call it trade war with Germany and other members of the EU. Yet we're seeing the stock market in the second part, as we're now back into the latter part of the day, able to recover, and that gets interesting. Another rally up in the energies, and as I told you, the energy market is starting to worry about, is the Trump administration going to abandon the nuclear treaty? If it does, do they put sanctions back on Iran? If so, less oil on the market, so the market's not sitting still. And we got a bit of a bounce today, as you can see in the wheat and the soybean market off the huge break yesterday, but it didn't get back much of those gains. So as we look at a weekly area chart of just the closes in beans, you're down 21 cents. You're in what I call a down thrust now. You've got a pattern here, almost like a swing line, lower highs, lower lows. Yes, the overall bias is up because you're still over the 18-week moving average of closes. On the daily chart, you got a little bit of a bounce off this 1022.5 low. The market dropped approximately 55 cents. Still has a pattern, if you will, where you're under the 18-day average of closes, so the bias remains down. And as you can see on the charts, is this just a pause before we get another leg to the downside? Inside days are often a pause leg. So as I look at the chart for clues, I can't help but notice that on the swing line study, and this is a chart without it, but when you put it on, I can see very clear peaks. I've got lower highs, certainly lower lows. Therefore, the trend is down until the last peak is taken out at this 1050 level. The 18-day moving average of closes is at 1051.25 and probably going to get under that 1050 number as early as the reopening tomorrow because you have this number replacing a number 18 days ago. The weight will just probably take it down under that. In the Bollinger Bands, which is something I use and something that was developed by John Bollinger to keep a market, it's an algorithm designed to keep the markets into an idea of 95% of the time it'll trade within the band so you get an idea of some resistance and support points. It is much more than that, but that's the simplistic part of it. So when you hit yesterday the lower Bollinger Band, to get a bounce off of that, that's where I think the pros were covering shorts. You still have support between 1019.75 and 1009.25, but understand that is support where maybe there's more short covering. Picking a bottom, well, that's up to other traders. I can only tell you momentum is down and oversold into support at the Bollinger Band. If the market accelerates the break, 1009 is the next number, and bias is down, trend down. In the meal market, you have an embedded reading. Now, when you embed, it means that you've walked away from the idea that a market's oversold. Instead, it's locked in a trend. That trend is now to the downside until the red line closes back over 20. Therefore, you've got lower highs, lower lows. You're riding the lower Bollinger Band. That could be very dangerous as it keeps working its way lower. In the oil market, you rallied back today, stopped at that, what I call that line in the sand. And let me explain that. A line in the sand, to me, is an important number on a chart. You know how the president drew his lines in the sand. Well, on a chart, I think it's the 18-day average of closes on practically every chart. If you go back, you'll see often the market rallies, it goes back to it. If it breaks, it tries initially to find support at it. Not uncommon action, or to even just whip around it as it tries to figure out what to do. Some people like the 20-day average. Some like the 21. Doesn't matter to me. It's the concept. Which one of those averages are right? It doesn't really matter to me because I have so many other little things that I work with, but I've grown over the years more comfortable with the 18 than any of the other as I've used them all. When I look at corn, you're down to the point where I'm looking for the support, the short covering right now, not 3 days from now, literally right now. You have a higher high, a stretched out lower low, and you're oversold. Wheat's already there. You hit yesterday both the lower Bollinger Band, the 100-day average of closes in green, and you're getting a little bounce. Oversold as can be, trend down and resistance way back up here at 485 3/4. In the sugar market, a big rally yesterday, knocking the trend, if you will, the downtrend that had been established by lower highs and lower lows all out. You now have a lower low and a higher high. That's not an uptrend. That's just the end of a downtrend, an oversold market with downside bias. In the coffee market, I think the trend is trying to resume to the downside. My dilemma is it's doing so in an oversold market. I hate that. Got a higher high and lower low. Even if it tries going down, 117.95 is going to be your first support zone. So be a bit cautious about that because of the oversold condition. Cocoa market lost its embedded reading. As I said, it's not uncommon when that occurs for price and the 18-day average to make a run at each other. They began that process today. Even though you closed higher, you made the lower low. We'll see if it's able to get down there. Real strong markets have a way where the market, the 18-day average works its way up, and this number, the price doesn't have to drop as much as it normally does. Something to consider. In the cotton, just missed hitting the lower Bollinger Band, went back to the 18-day average of closes to figure out what to do next. The overall trend is still one of lower highs, lower lows. Momentum had gotten oversold yesterday. Today it climbed back up where it's not. It's got both numbers over 30, and that's one of the things I look at. If you paid attention to what I said on meal, you have an embedded reading. When you're leaning against the lower Bollinger Band with an embedded reading, you can run on that band. That's the definition of running. And what that does is it doesn't give the bulls any chance, or those that are trying to pick bottoms, any chance out. The market just keeps plunging on you, and that's exactly what you're getting in the cattle. The feeder cattle are right with it. These are people caught, and when you try to pick bottoms, that's what happens. And all that a chart is a summation of all the price action taking place. And even the hog market's slipping back to the downside. I'm surprised this hasn't been weaker, because if China comes after us for any reasons, with and good ones, to counteract our tariffs that we're putting on steel, aluminum, and maybe 45% of the goods they send to us, hogs could be one of the markets. They import hogs and beans, so be a bit careful if that's the way that you're thinking. My charting course. I want you to consider this. At about $130, you get charting software, access to my updates, my knowledge, a morning video, all my written recommendations, and then 60 videos that teach you how to work with swing lines, moving averages, and there are more moving averages than I show here, very important ones, slow stochastics and the tricks that I've learned about them over the years, Bollinger Bands, the different definitions that I give you, how to work with them as they're running, and another profit-taking tool called window envelopes. They'll make up the basis of what you do, and your charts will end up looking a bit like this. It's quite a lot. You get numbers to put on for the window envelopes every day. But the whole idea here is you learn to do what I'm doing in the same manner, and then you can expand on it any way you want. You may just want another idea. I've seen charting courses, there are thousands of dollars out there. I've seen others that try to narrow it in. I think I've got the most complete package on the market, all, if you will, online for you. Easy to work with, and I know that what I do is I take PowerPoints and give you the definitions and the working, then I take you to a real chart in the next video, show you how to do it, what the chart looks like, and the data you get in my charting software will also, not only has current data, goes all the way back, you'll be able to do exactly as I do, and then in the mornings when you come into my morning video, I'm going to cover 40 charts, and I'm going to harp on the different things you're learning. Then, every couple of weeks now, you get a live webinar I invite you to, and you can ask me any questions you want. I'll do my very best to answer them. So how do you get yourself to the point where you can do a lot of this? And remember, our charting software, if you will, the download version even does the stock market, so you can work with that. Simply give us a call. You can go to our website under the word education. It has more videos. It explains all the details. Very inexpensive. You can click up here if you want to see it also. That'll take you right to the page. I'm Ira Epstein. You have a good day, and I will talk to you all tomorrow.